All right, so here we go. So I want to welcome everybody today to our live Q&A with the editor of the Prudent Speculator, John Buckingham. My name is Jason Clark. I'm a partner with John, and so on behalf of our full team at the Prudent Speculator and Kovitz, we just want to welcome everybody, and we are grateful and humbled that you took the time to join us today. And so what's going to happen here is John's got a few slides that he wants to go through and share some information, and then we're going to get to the Q&A part. We received a number of questions beforehand, and you'll have the ability to ask questions during the session. And so if you look towards the bottom of your screen, on your Zoom screen, you'll see a question mark with Q&A underneath it. And so if you click on that and you want to enter a question, please do so. And then what you'll see me doing, and so I'll apologize, you'll see me looking around because I've got the questions we received beforehand on one side, and then I'll be able to see live questions over here. And so if we have similar questions, I'll try to combine them. And otherwise, we'll just move through them the best we can in the allotted time we have. If we don't get to any, then we will come back and reach out, or we'll put them on our blog on the Prudent Speculator website, and we'll put all those answers there. And as well as that, if you saw, this is being recorded, so you'll have a chance to go back, or for those that couldn't make it live, they'll have a chance to get it. One other just kind of housekeeping note, we just published a new investment insight called Small Cap Stocks Should Be in Your Portfolio. That is on the Prudent Speculator website if you want to see that. And we're just talking about why it is that we think small caps should be in your portfolio and why they're attractive at this point currently and on a historical nature. So with that, I am going to turn it over to John. And so John, take it away.
Thanks, Jason, and thanks to everybody for coming out this morning. One of the things that I've enjoyed doing when I speak at investment conferences or on cruises is a Q&A. Seems there's a lot of obviously interest in individual stocks, interest in takes on the market and our philosophy methodology. So we thought that we'd give our readers and those who know us a chance to ask specific questions via this format, and hopefully this will be something that'll be of value, no pun intended, to the audience that's out there. I do have some introductory remarks, and then we'll get into the actual Q&A. But we're in a market this year that has done well. Certainly there are areas of the market that have done better. Obviously, we're in a world where sometimes the financial fundamentals associated with the investments we own don't seem to matter. What might matter is, if it's got an interest on, Reddit or some kind of a social media platform. And so, it's been somewhat difficult to be a value investor focused on fundamentals, but we've done just fine. And one of the messages I like to convey is, we should be very happy and comfortable and content, if you will, with the returns that equities have delivered over the last decade, over the last 20, 30 years. And one of the reasons I say that is that the long run return for stocks has been roughly 7% on a real basis. Real meaning after inflation. So if you figure that inflation has averaged roughly 3% or so, to get a 10% return on equities on an absolute basis, 7% on a real basis is very good. So people should really have some, I guess, perspective is sort of how I try to put it into simplistic terms, is that you don't have to make 100% in a week or a month. I know we'd all like to, of course. But returns on equities have been very good over time. And what we should be expecting is, a 10% rate of return would be a reasonable thing to target. And of course, if you can have some decent stock selection, as we have over the years, doing even better than 10%, but something in the 11 or 12% range, would be fantastic. And then this particular slide shows how the real returns have been on bonds and bills and gold and the dollar. So it's very important that you want to continue to be invested, even in a stock market that some would argue is is richly valued. Equities have delivered far better returns than most other asset classes. And one of the other important things that I learned from our mentor, Al Frank, way back when, and Al was the founder of our newsletter, was that you don't have to get rich quick. You can grow wealthy slowly, and it's the miracle of compounding that is so important. And remember, I said that if you can get a 10% return on stocks, that's very good. And your money can grow substantially over time. And so the table that I have on this particular slide shows how the growth of money, in this case, I was using Dow 40,000 as kind of the catalyst to talk about the miracle of compounding. But you can see that we could be at Dow 1 million, hopefully within our lifetimes, by the year 20, well, guess it's not our lifetime, is it? 2084, but our children's or our grandchildren's lifetimes. But the dollars can compound over time, and it's something that has been super important to learn. Because when I started in this business in 1987, I wanted to get rich quick, just like all other young folks do. And what I found is that in my efforts to get rich quick, and I was an option trader on my own account, I ended up not getting rich. And if I had just put my money into value stocks, I would have been far better off. Happily, I learned that pretty quickly. And if those of you who follow the newsletter know, the Buckingham portfolio is one of the portfolios in the newsletter that we, of course, track and buy and sell stocks for. And that portfolio has grown from something like $23,000 or so when I began it to about $1.3 million today. And so again, the miracle of compounding is an amazing financial tool. And I think people should really come to appreciate that you don't have to make, 20, 30, 40% a year to have your wealth compound over time. And unfortunately, investors don't seem to make that 10% return. They end up shooting themselves in the foot, primarily because they trade in and out of stocks. And the problem that folks have is that they get excited about favorable periods, such as, say, we're in right now. And then when the markets go south, they can panic and end up selling out. So, the whole adage of buying low and selling high is what we try to subscribe to. But having a long-term disciplined approach, being patient, sticking with stocks will allow you to, again, achieve your long-term investment objectives, in our opinion. And we hope that we've provided a lot of the comfort, if you will, or the ability to keep the faith, through all of the ups and downs. If you remember back in 2020, the pandemic was a very terrible time for the stock markets, obviously for humanity as well. But we put out special reports talking about how viruses have occurred before and they will occur again. Hopefully not as bad as COVID was. But again, the financial markets have managed to survive through thick and thin, pretty much no matter what. And again, in the fullness of time, reward those who stick with them. And the reason for this is not, it's not some magic, magic ability of stocks to somehow levitate and defy gravity and so forth. The reason that equities have proved to be rewarding over time is that the economy has grown over time. The economy expands. Now, what I'm showing in this slide, the blue line is the nominal economic growth. And you can see the GDP has grown from 10 trillion to over 30 trillion. And over time, the rate of growth, even on a real basis, on an inflation-adjusted basis, has been strong. And so over time, the economy grows and corporate profits grow. So again, it should not be a surprise that stocks have proved rewarding. They are reflecting the fact that earnings have increased, and earnings have increased because the economy grows. And obviously corporations, hopefully the ones we invest in, are doing the right things to improve their business and to grow their business over time. And that has been the reason that equities have been successful. And again, I know so many people, especially newer investors, think somehow the game is rigged against them. or that the fat cats on Wall Street have control everything. But the moral of the story is that businesses become more valuable over time because their profits and their sales grow over time, and their profits and sales grow because the economy is expanding. And speaking of newer investors, so many these days seem to view investing like a video game. And they have their Robinhood accounts, and you get the fanfare if you buy a stock. And it shouldn't be a game for those who are investing for the long haul. It should be like watching grass grow. And again, that gets back to that miracle of compounding. You don't have to make a fortune overnight to see your nest egg increase. And that doesn't mean that you can't have some fun. And again, as Paul Samuelson says, if you want excitement, take $800 and go to Las Vegas. Or as I wrote in the last newsletter, maybe you want to take a flyer on a meme stock or something like that. Nothing wrong with quote unquote gambling on a few names here and there, but the core of your investments should certainly be in what we think anyway is a broadly diversified portfolio of undervalued stocks. See if I can get this to go down here. There we go. And speaking of undervalued stocks, I want to offer the reminder that, value historically, and of course we are value investors, we seek to buy things that are on sale. We think that makes sense. We think it makes sense because generally speaking, it's the way most of us live our lives. Even if you want to buy the Lamborghini, you still want to get a good deal on it. So there's nothing wrong with buying inexpensively priced stocks that you think will appreciate over time, not just because that their PE ratio today or their valuation today may be cheap, but we're buying businesses that we think will thrive in the fullness of time. We just want to buy them at inexpensive or reasonable price tags. And just because we're buying undervalued stock doesn't mean they don't go through ups and downs. And one of the things that investors have to be prepared for is volatility. These slides show that 5% declines happen 3 times a year on average. I was just reading something this morning, I think it was on Market Watch, that said, we should be braced for a 10% decline. We might have one in the second half of the year. Well, a 10% decline happens, once a year on average. And so the idea that somehow, a 10% decline is something we should be nervous about or scared about defies what the historical data shows. So value stocks have proved rewarding in the fullness of time, better than growth stocks over time. And further, dividend paying stocks, and as most people know, we do like dividend payers, they've outperformed non-dividend payers. So our investment strategy is designed to go where the historical opportunities have arisen, but also to invest in a common sense way. Buying things that are cheap is, generally speaking, a way that most of us should be living our lives. And we also have to deal with the headlines. And I know that there are many folks that are very nervous about, we have the election coming up. There's a big debate tonight, of course. There's trouble in the Middle East. There's trouble in Ukraine. There's all sorts of things to worry about. But there's always things to worry about. And I like to put up all of in this particular slide, it's only going back to since the great financial crisis. But there have been a lot of things that seemingly would provide consternation to investors that have occurred over that time, including the pandemic. And yet stocks have managed to persevere and grow and appreciate no matter what has occurred in time. And I'll kind of leave it here at the end of the prepared remarks with just a reminder that even though the overall stock market by many measures is at elevated levels from a valuation standpoint, value stocks, generally speaking, are not richly valued. Value stocks are a little more expensive than they have been over the last 29 years on a PE basis, and that's the gray line. But the blue line is growth stocks, and they're much more expensive than where they historically have traded. So again, I think that it's a market of stocks and not simply a stock market. And value stocks, in my opinion, should be representing a substantial part of your equity exposure. And furthermore, the gap, if you will, between value and growth today is, believe it or not, as high as it's been at any time since the tech bubble. And it's even, the difference today is even more extreme than we were back in the year 2000. So again, we've got a market where there's a lot of interest, if you will, in the AI trade. And we participated in the AI trade with many of our reasonably priced stocks. But I still think that there's tremendous opportunity on the values side of the spectrum. And now more than ever is where investors should be moving, if, in my humble opinion, over toward value from growth. And speaking of, our portfolios, I like to show this slide all the time because our stocks are, generally speaking, less expensive than even the value indexes, and our dividend yields are higher than the value indexes. So we, as I like to say, we don't lose any sleep over where the market is today, because our portfolios are not the market. Our portfolios are a collection of undervalued businesses in our mind that are generating substantial profits, and those profits are able to be returned to investors via buybacks as well as generous dividend yields. And so we feel very good about the state of affairs of our portfolio, even as we understand that there are areas of the market that many would argue are overvalued or richly valued. So I'll conclude here with these remarks. Whether we're talking about stocks or stocks, I like to buy quality merchandise when it is marked down. That's Warren Buffett. And again, there are many stocks today that we think are marked down, and that's always been the case. I mean, I've been at this since 1987, and it's always been a seesaw or a teeter-totter, where some areas of the market attract interest, others don't. And our job is to take advantage of the things where everybody has decided that they want to own that particular sector or industry, and the stocks have appreciated in price significantly, and then take money out of those and move money back into other areas that have not had their day in the sun, and continue that process over and over again in a disciplined way. So that's kind of the overall message I wanted to leave folks with today, is that value stocks are still very attractively priced. Our portfolios are even more attractive from a valuation and dividend yield basis, and we should be very happy and comfortable. We're looking at, if we look at returns on our portfolios, year to date, something in the 8% range is where we're at today, maybe 7 to 8%, and that's very good. We should not be saying, well, gee, I could have got 100% on NVIDIA. We should be very comfortable that having a disciplined approach is going to generate and produce substantial wealth over time. So with that, I'm going to turn it back over to Jason, and we'll take some audience questions. But thank you.
All right, thank you, John. Thanks for sharing your insights and preparing those slides. So just housekeeping again for everyone who might have joined after we started. Down at the bottom of your Zoom, you should see a question mark and a Q&A. And so you can you can click on that and enter live questions. So we had a number of questions submitted before this, as well as we're getting a number of questions that are coming in. So I'll put some together where I can, and then we'll just go through them one by one. And at the same time, we're going to do this all within a time frame. We told you we'd do it up for 1 hour, and so we'll do that. And if we don't get to something that you asked, we'll either reach back out to you directly, or we'll put the response on the website on our blog. So with that, John, first question that we received, and we got a couple of them like that. I read in a recent sales alert that you sold Broadcom above 1,800, but you waited 2 days to sell for newsletter portfolios. I'm confused. Can you explain?
Sure. Well, way back when, Al Frank, the founder of our publication, was worried that if he were to trade and then tell people what he did, that would be viewed as front running, or somehow that he would move the market and he would be taking advantage of readers' activities. And so we've always had that mindset that, we care about our readers. We want to have the concept that we are investing for the long term. And it's not about a short term kind of a game plan. So we don't think that we're going to be jeopardizing our own portfolios by waiting 2 days. Now, in the case of Broadcom, of course, the stock went down precipitously after we announced it and sold it for our clients. And it's very important to understand that we do have a money management, a wealth management business. And so we do have clients who employ us to manage their portfolios. So when I write that we sold the stock, we sold it for clients. We announced it to our readers so they can also trade ahead of when Al Frank's estate, Al passed away in 2002, or my own personal account would transact. So that's kind of the rationale behind it. We wait 2 days. These days with settlement on trades now down to 1 day, maybe we don't need to wait as long. But we just think it's the right thing to do. And again, it's optics, if you will. We don't think we're jeopardizing our own performance on our own accounts. But we just think it's the right thing to do so that our readers and our clients, of course, go first. And we do things for our own portfolios after we do it for clients.
All right, John, next question. So earlier in your slides, you talked about long-term stock returns, both on a real and nominal basis. Question, what type of annualized return should I be expecting to make from stocks going forward? They didn't give a time frame, but you can choose the one you want.
Right. Well, again, we're students of market history, so whenever I'm asked that question, the foundation is, well, what have stocks returned historically? And value stocks have had a 13% rate of return roughly since the founding of our newsletter in 1977. So that would be my foundation of where I would begin. A 13% return in value, something like a 10% return on the quote unquote overall market would be a starting point. Now, of course, we always want to be reasonable and realistic. When we think about equity returns, the last thing I want to do is say, hey, you told me 13% on a webinar and I made 12%. So you must be, very disappointed in how stocks have performed. No, my expectation over time is that equities will continue to produce that Jeremy Siegel 7% real return. Inflation, we can debate how inflation is calculated, of course, but the expectation is inflation may be in the 3% range, coming down a little more. So if you use that as a level, you might say 9–10%. Now, having said all of that, we do also offer financial planning to our clients, and we try to be even more conservative in the plans that we create. And so the return that we're using there is roughly 8%. So again, a reasonable expectation from equities would be somewhere in the 8 to 12% in my mindset, based on where we are today in the overall environment. If you're investing in growth stocks, I would expect lower returns going forward. If you're investing in value, I might expect more on the upper end of the spectrum. But again, that's the miracle of compounding. If you make 10% a year, your money doubles in 7 years, roughly. And then doubles again in another 7 years, and then doubles again in another 7 years. So it's amazing how time moves. My daughter turned 29 today. I can't believe it. How time flies. And so the key, of course, is to get your money in to work for you, because time in the market will trump market timing. And the miracle of compounding is an amazing thing.
All right, I almost had to cut you off because we have tons more questions coming in. So next one I thought was pretty interesting. My son's been trading GameStop and other so-called meme stocks like he is playing a video game or a slot machine. What advice would you offer me, as I view this as gambling and not as investing?
Well, I did see somebody on one of the talking heads on CNBC trying to say this is horrible, that the young people are just going to lose their money. and it's such an awful thing, and we need to put a stop to it somehow. My view is a little different because I've got a few gray hairs, and I remember back in the year, 99, 2000 in the tech bubble, and day traders were getting rich, overnight. And what happened is they learned valuable lessons. So for the young people today, remember that young people are going to inherit a substantial amount of wealth. What I would like to see them have is go through the school of hard knocks, to learn some valuable lessons, to learn the miracle of compounding, to learn that valuations matter, to learn that businesses should be, you should focus on not just how the potential growth of the business is, but also on what you're paying for that growth. And so my recommendation is to let your grandson, play around, because that's the only way you learn. That's how I learned. I traded options, and I thought I'm going to get rich by buying this and hope at $3 and selling it at $9, 4 days later. And what you learn is that most people don't do very well trading options, and that the GameStop investors, some of them will manage to time it well, and not to continue to harp on GameStop, but the fact that they were able to raise a ton of cash from all of the euphoria here recently allows that company to survive, and a lot longer than it otherwise might, because it's not a business that we would want to own today, but it's certainly a balance sheet that is far more interesting than it used to be. So let your kids have their fun, because what you want them to do is to learn the lessons when they're talking about $500 in their account, as opposed to when they just inherited $500,000 from you.
All right, John, next one, and funny because it was your last slide. You quote Warren Buffett quite a bit, but I don't see Berkshire Hathaway stock on your recommended stock list. Why is that?
Right. And, the interesting thing about Berkshire is we don't think it's a value stock. And that's funny to say because Warren Buffett, of course, is the grandfather of value investing, or the father of value investing, if, Ben Graham is the grandfather. And Berkshire Hathaway just doesn't qualify, in our view, as an undervalued stock. And you also keep in mind that Berkshire Hathaway is a conglomerate. It's difficult to value because you have all of the equity owner stakes that they have. So it's a holding company on that perspective. But then also it's an insurance business. And so we like insurance. And we have, insurers that we think are much more reasonably priced than Berkshire is. And we also would rather own individual stocks that are attractively priced. And we do think that Buffett owns some of those, like Apple. But he also owns things that we don't think are inexpensively priced, that we don't want to own. So long-winded answer is it's not a value stock. It doesn't score well enough in our proprietary scoring engine to allow us to buy it. Doesn't mean it hasn't rewarded investors who've owned it, and I get that, but it's not a value stock, so we don't own it.
All right, I'm going to come back to some questions around the scoring engine, the algorithm, valuation, some of the metrics, because we got some good questions around that, I think. But let's jump into just some individual stocks that we have questions on. Question of, do you like Boeing or Disney here at these levels, or both?
Right. Well, certainly those are good questions, because both stocks have been poor performers. Disney, of course, has bounced back somewhat. And as readers of our newsletter know, we do like Disney. We would be a buyer of Disney today. And we think there's excellent long-term value associated with Disney. Premier theme park operator, and historically a great ability to monetize their assets, meaning that if they have a movie that has produced great interest, they can then create theme park rides out of it, merchandise out of it, television programming out of it. So it's a fantastic company in our view, and one that investors should own. Now, Boeing is a name that our investment team has debated quite a bit, and Jason will smile at that. Boeing just doesn't score well enough in our engine, and I know we may talk about that a little further. But Boeing doesn't qualify for investment for us today, number one. Number two, from a valuation standpoint, it's still tough to value. They have negative shareholders' equity. There certainly are concerns, obviously, about the max and its future, and so it's just not a name that we would be comfortable owning today, based on our disciplined value approach.
All right, thank you. A couple more here. Do you still see attractive upside in names like Microsoft and Apple that have been having their day in the sun for years here, I think?
Well, that's a great question, and I know probably one that we get a lot from those who know us as disciplined value investors, because Microsoft and Apple and a few other stocks have done extraordinarily well for us. We bought them when they were cheap. We bought them, when nobody wanted them. It's hard to believe that people didn't ever want these companies. But there was a period where they were attractively priced and we were able to pick them up. Just as we were able to pick up, Meta, Facebook, after it had a colossal collapse. And of course, those who know us from the newsletter will know that we were very early on our Meta buy. And frankly, it lost something like 40% of its value after we bought it, but we didn't panic. We stuck with it. And of course, our purchase at $150 or so looks very good, based on where Meta is trading today. So the names in particular, though, we still think there is upside potential. We still think there is value, but we have taken substantial money off the table along the way on Apple and Microsoft, and even on Meta, we took some money off of the table as well. So that's part of our disciplined approach, is letting our undervalued stocks grow from the extremely inexpensive stage to the, where they may start to become fairly valued, and maybe even where they might be a little richly valued. We're going to take money off the table along the way, reduce our risk, reduce our exposure, and then again, turn around like the farmer and plant those seeds in new, even more undervalued stocks. But we're still willing to hold Apple and Microsoft. They're still among our largest holdings, not because we bought so much of them, because they've appreciated significantly. But to kind of bring it full circle, we are running a little bit of cash in our portfolios these days. And so as we have new investment ideas, those names would potentially serve as a source of capital, source of funds, to buy other names. But if you don't have Apple and Microsoft, we think it's certainly reasonable to pick some of those stocks up, hopefully on a day when they've had a pullback. But we still think Apple, Microsoft are names you want to own in a broadly diversified, value-oriented portfolio. And when those metrics I put on the screen for our portfolios include the fact that we own Apple and Microsoft, and yet our metrics are still below those of the value indexes.
Next question here. Stock I'd like you to comment on is the symbol CAMT, Charlie Alpha Mike Tango, Camtech. Would you recommend your readers in owning this stock? And then the questioner also says, I own the stock VRT, as well as CAMT. Should I keep both? I'm looking forward to your response.
Well, happily, that questionnaire had sent that question ahead of time, so we could actually look them up. To be candid, we don't follow them. We don't know much about them. We did a brief look at them, looked at how they might score in our proprietary, valuation algorithm, and neither one is a value stock. So they would not be names that we would be wanting to own today because they are not attractively priced. I mean, if you look at PE ratios and price to sales and price to book ratios, these are stocks that are trading at sky-high multiples. Doesn't mean that they aren't good companies. They're just richly priced, and they have attracted quite a bit of interest from Wall Street, which is great. Nothing wrong with that. Again, we own Microsoft and Apple and Alphabet and names that have also attracted quite a bit of interest. But if you're asking me if I would buy them today, the answer is no, because they're not value stocks. And again, we're disciplined in what we do. If you're asking me, should I be selling them? Again, I don't know enough about the businesses to be able to say yes or no on that. All I can say is based on valuation, if we had to classify them as buy, sell, or hold, they would be sells because of our value approach. So sorry, I can't give a better answer to that. But again, these are businesses, and including the first one that was asked about was, if my memory serves, was in a batteries or more in the electric vehicle kind of a space. And we do have businesses that are poised to benefit from EV growth, including a name like Albemarle, which is a lithium producer, ALB. We own Enersys, which is a battery maker. ENS, as in Sam, is a ticker. So I would rather own Albemarle or Enersys if you're looking to focus on things like renewable energy or the growth of EVs.
All right, we're gonna pick up the pace here a little bit, John, as the questions keep rolling in. When deciding which companies to invest in for your portfolios, do you consider international value stocks or ADRs?
Yeah, good question. We do consider ADRs. We have 6 or 7 of them within the newsletter recommended list. And so we don't discriminate, but they do have to trade in the US. And so many ADRs do. And we follow roughly 200 or so in our valuation algorithm. And we feel that we have found some good opportunities in them. And frankly, the European markets are still very attractive. In all candor, more reasonably priced in many instances than US stocks. And so we don't want to discriminate. So the quick answer is yes, we do like ADRs.
All right, so I'm going to combine a few questions here, and this is one I can tell you all John could talk about for hours, but I'm going to ask him to do it just in a few minutes. So a combination of how do you determine fair or intrinsic value, talk more about your process, and then also a question that was posed, can you talk about some of the other valuation metrics you also consider when analyzing a stock that aren't traditional PE, price to sales, price to book, price to earnings? So just kind of all of that together, the process, determining intrinsic value, target price, and I'm going to keep you on the clock here for about 3 minutes. And
oh boy, 3 minutes. That's not going to work. Well, again, our process is threefold. We have a backward-looking valuation algorithm that evaluates companies on a variety of metrics that have proven to be good predictors of future stock price appreciation. So things like price-earnings ratio, price-to-sales ratio, price-to-book value historically have worked well. You asked about some other metrics, free cash flow yield and enterprise value to EBITDA. Those are 2 metrics that have really scored well in our backward testing analytics here of late. So we incorporate those into our valuation algorithm. And that algorithm is designed to get us fishing in the right pond. It doesn't mean that every stock in there is a buy, and it doesn't mean every stock that's not in the right part of that algorithm is a sell. There's also then a qualitative review that needs to go on with each of the stocks that pass that first test. And assuming that we like the business of the company, the management of the company, the competitive position, and a variety of other qualitative factors, and in addition, even more quantitative factors such as debt maturities, strength of balance sheet, things like that. We then have a third part of the puzzle, if you will, which is setting those target prices. And the target prices are our assessment of where we think a stock deserves to trade over the next 3 to 5 years. And that incorporates growth. Even though we're value investors, we're still looking at where our revenue, earnings, book value, where are these likely to grow to over time? And then that will help us establish a target price. And then if the stock is trading at a significant enough discount to the target price, we would be a buyer of that company. And for us, we're looking at a total return picture, because remember that dividends are an important part of our process. So it's what is the capital appreciation and what is the income portion of the return that we're likely to achieve. And then is there a significant enough upside for that combined return versus the risks associated with the company not achieving the objectives or the targets that we have set. So I know that I'm trying to keep it short, but the idea is that there are financial metrics that have worked very well historically, but we don't just sit here and say, well, price to book value is the best metric when price to book value has been an awful metric, frankly, for the last decade or so. Free cash flow yield, enterprise value to EBITDA are the two that we put in the newsletter that we do talk about. Those are metrics that if we were to sit here today, we would say if I had to choose one, it'd probably be free cash flow yield. And I think Jason will nod his head yes. That would be a metric that investors should be looking at as a great arbiter, if you will, of what is a value stock and what isn't. But the great thing is that stocks that score well on free cash flow yield have delivered great returns over the long haul of our studies, but also more in the short run as well. So we're always trying to get better. We're always looking at financial metrics. But for us, we have to be very careful about, we don't want to, have kill the goose that's laid the golden eggs. We are value investors. We have done better than the value benchmarks over time. And so to try to quote unquote improve or fix our process runs the risk of, jeopardizing the returns we've received. So as the keeper of the flame, we're very careful to ensure that anything we add is well thought out and frankly isn't a double counting, because there are other metrics you could use that say, hey, well, if you just combine this and this and this, but we've already incorporated that with, say, free cash flow yield. So I just think that the approach of being disciplined and establishing target prices and buying things when they're trading at a significant discount to your targets is the best way to go. And for us, we've always had a target price system or process since I got here in 1987, and we've improved and tweaked and so forth, but we've always maintained that concept, and I like it very much.
Awesome. Okay, well, we're going to get back to some individual stocks a little more rapid fire. What do you think of CVS going forward, even after competitor Walgreens has shown weakness and a big weakness today?
Yeah, CVS is a name that we've long liked, a name that has not had its day in the sun of late. Of course, our ownership of CVS goes all the way back to Aetna, which is their health maintenance organization division. And so CVS is very much different than Walgreens in that it's not just retail pharmacies. CVS has the Aetna division. They've made acquisitions to try to create their pharmacies as a medical hub for folks to go to. We still have confidence in that, but more importantly, the valuation is still very, very inexpensive, and the dividend yield is generous. So even with the Walgreens news, and frankly, because of the Walgreens news, CVS is down today. If you don't own it, I'd certainly be looking to pick it up, especially on weakness today.
All right. All anyone seems to talk about these days is NVIDIA. Is it too late to buy?
Yes, it's too late to buy in our mind. We do follow NVIDIA, as we've written about in our market commentaries. We used to own it way back when. It was a value stock at one point. It became not a value stock and we sold it. We followed it for a long time, and it never quite got back to where we would want to buy it again. Now, having said all of that, we started this discussion with Broadcom. Broadcom is an AI stock that has done very well. It's become an AI stock, right? Microsoft has become an AI stock. Alphabet has become an AI stock. Heck, Apple has even become an AI stock. And other names like Lam Research, in the semiconductor space. So we have exposure to the trends that are benefiting NVIDIA. Hindsight's 2020. Of course, we wish we would have owned NVIDIA and never sold it, because we did actually own it in the past. But it's not a name I would be buying today. That doesn't mean that we won't buy it at some point, because certainly it's a booming business, and the valuation obviously it is expensive. But it's grown into valuation after valuation through the years. So NVIDIA is not a name I would buy today. If you feel you must own stocks in the AI space, Lumentum, LITE, is an AI play, and other stocks that have pulled back recently, like a Broadcom, which has gotten whacked again. That would be a name that I might look to put some money in ahead of NVIDIA.
All right, next, do you like Oxy, Sunoco, Conoco, or other beat-up oil companies?
Well, we like the last part of that, the other beat-up oil companies. We like energy in general. We think there's great long-term opportunity there. And so, recently in the last, year or so, we've added a Chevron and Devon have been new recommendations in the newsletter. There's nothing wrong per se with a Conoco or an Oxy, but we think there are more attractively priced names. And so if you have those, I would certainly say it's fine to keep them. Or they would be more in the hold camp for us than a sell. But we like HF Sinclair, Dino, DINO as a ticker symbol, as opposed to say a Conoco in the refining area. I mentioned Chevron, Devon, a company called Civitas Resources, CIVI, if you want to be in the exploration area. And even the big majors like Total Energy, TTE is the ticker symbol there. So I like the energy space, so I wouldn't be a seller of those names that were mentioned first, but I prefer others in that space.
Okay, BMY Bristol Myers appears among the 10 stocks in the Port Builder section of both your May and June newsletter. As a longtime subscriber, I know that's very rare. Is this an indication you view BMY as exceedingly undervalued among your recommended stocks?
They might have been in there 3 months in a row. The recommended stock list that we pick for each newsletter, what we do try to focus on are things that have not been talked about, or things that are especially attractive for a particular reason, or that we want to add them to one of our newsletter portfolios. So Bristol Myers was a name that we added to the newsletter portfolios, and then we wanted to add it to another portfolio. And there was additional news that occurred after the first recommendation. So the simple answer is I usually try not to, since I'm the guy who picks them, I try not to repeat them as often. In this case, it was a situation where we were adding it to a portfolio. And as we were doing that, then it needed to go into the next month's portfolio builder. And I will share with those who are on the call here that we will be doing that again this coming month in the July issue. There was a stock in the June list that will also be on the July list.
I should have thrown this in earlier with the NVIDIA question, John, but I lost my question. That's not good. What do you see as reasonably priced AI companies now, or that have AI exposure that maybe that we own or that we find interesting?
Well, the problem with that is that anything AI related generally has exploded to the upside, including things that we've owned. I had mentioned Broadcom earlier. I mentioned Lumentum, which is maker of optical components. So it's the hardware, if you will. Remember, NVIDIA is a hardware. Well, we can debate software, hardware company, right? And so the picks and shovels has always been my interest when we talk about these trends. So the companies that make the chips. So something like a Lam Research, which is a semiconductor capital equipment maker, although Lam has performed extraordinarily well. There are other semi-cap companies like Kulicke and Sofa. KLIC is the ticker symbol, or even Cohu, which is a maker of test equipment, COHU. So there are some names that have been overlooked or are still attractively priced. And then we can even come back to Intel. And I know Intel is not a quote unquote AI stock these days, even though they certainly are playing in that space. And, historically, at least in the last, 5-6 years, Intel has been a laggard. But we still like Intel. We still think that they will, quote unquote, get their act together. We like the fact that they're producing or are building fabs, production plants in the US, especially given all of the discourse about China and Taiwan. I like having something that's got US manufacturing at least coming down the pike. So Intel would probably be a name that I would be looking at as something that has not had a tremendous run. Of course, it's gone the other way. Lumentum and Intel are both names that have really been hit hard, and that would be where I would focus if I were looking at a new AI stock today.
All right, we've got less than 10 minutes, so I'm going to do just a couple more on the stock front, and then I'm going to shift into some more portfolio management questions. So quickly, we do not avoid the hard questions. So here's one for you, John. What is your current opinion on Leggett & Platt? Is it a broken company? or do you think it can recover? Would you invest more at these current levels?
Yeah, Leggett and Platt, and as I appreciate the question, because just because we have a fantastic long-term track record doesn't mean that all of our picks work out. So Leggett and Platt has been a dog with a capital D. When we bought it, it was reasonably priced, had a big dividend yield. It was a dividend king, not just an aristocrat, a king, had raised the dividend for 50 years running. Here recently, they had to cut the dividend. Business has really struggled. Still profitable though. Still paying a dividend. Not what it used to be. So we're still willing to hold it, but we have not had the stomach, if you will, yet to buy more of it. And so it's been a name we've debated from a qualitative perspective here on our investment team. And as of this moment, we're not ready to buy anymore, and we're not ready to sell it. But we're willing to hold what we have, and it is a very small weighting in our portfolio at this point. So at some point, we will have to make the decision, take the loss, the tax loss, which can be beneficial given all the gains we've taken this year. But not a name we've been comfortable enough to bring up.
Okay, next question on a little pivot here for the next few minutes. Given that a portion of the average investor's assets are invested in a 401k, and that a staple of every or most 401ks is the S&P 500, and so such a great portion of a personal earnings go into the S&P 500, do you see this as good for a value investor or bad?
Well, it's an interesting question because obviously there is a lot of money that is earmarked to the indexes. The problem, of course, with that is when the tide turns, as we saw in 2022, where the S&P 500 was a laggard, and just as all the money can flow in, it can flow out. We saw that with Nvidia here recently, where the stock went from 135 to 115 very quickly, and it wasn't as if Nvidia did anything wrong. It was just a shift in sentiment. So for a value investor, we think that creates even more opportunities to sell high, like Broadcom. I mean, if Broadcom didn't become an investor darling, we never would have been able to sell it. Now we bought Broadcom, back at $250 or so, and we, candidly, we sold some at $1,300 and some more here in the $1,800 range. And so it creates opportunities for the masses to bid up stocks that we bought when they were cheap, and then to also be abandoning stocks. So the divergence between the haves and the have-nots is wider these days. And for a long-term investor, I think that's a good thing. It creates opportunity, not a bad thing.
Next question. How do you factor in client taxes into your analysis for your portfolio management decisions on an individual client basis?
Right. Well, that's always the interesting thing is that, we deal with individual folks. We have 400 or so families that whose assets we manage. And so tax sensitivity is always an issue. Obviously, in retirement accounts, it's not an issue. But generally speaking, we are very cognizant of the fact that people may have gains. We have a client who owns Nvidia. We can't sell it because he has a massive gain and doesn't want to pay the taxes. So in that case, we've written some calls against it as a potential, risk mitigator. And so every account every individual is unique, and we want to pay attention to clients' overall tax situation. But having said all of that, paying taxes is part of the process. Our founder, Al Frank, he used to joke he'd like to pay $1 million in capital gains taxes because he thought he could be very happy, in those days with the 4 million he would have had in overall gains. And so paying 1 million didn't seem like a bad thing to Al. And so, it is part of the game, but having a diversified portfolio allows you to do things like, we mentioned Leggett and Platt. If you had Leggett and Platt in your portfolio, you certainly could swap out of it, realize the loss, and help to offset gains from things like Broadcom or Qualcomm or all the things that we've sold so far this year. So that's the advantage, if you will, of having a diversified portfolio. Not everything's going to work out, and we can manage those things for clients, but that's all individually client driven.
I'm going to read off a couple questions together and then ask you to respond. So this one says, "Hi, John. Do you have an interest in bonds or bond ETFs? Your perspective on muni, treasury, corporate, or even closed-end funds would be appreciated, as well as thoughts on bonds and where they fit with your value equities in the current yield environment."
Right. Well, that is a whole nother level of thought process, because remember, we are a wealth management firm. We do look at clients' overall situation, which can include a fixed income exposure or an alternative investment exposure. And so, the focus of this particular your Q&A, obviously, we're happy to answer any questions, but most people care about the equity side. But man does not live by equities alone. And so for many of our clients, we do have a mix of investments, including we do offer fixed income portfolios. Again, everything what we do starts with a plan. What are your investment objectives? What are you, and how do we reach those, with a risk level that you're comfortable in? These days, my comfort level is with stocks, and I like the yields are on T-bills. So for people who have short-term cash needs, T-bills are a great place to park your money versus bonds. Now, if you have a long-term, plan, there may be 20 or 25% of your portfolios in fixed income. We think individual bonds are a better way to go. We do that at Kovitz, as opposed to investing in ETFs. And we do offer muni bond ladders and things like that. So we think that those who have an interest in a bond allocation should certainly reach out to us to consider that.
Okay, we also received a number of questions that I'll kind of just respond to on how you can get more information. We had a question around the small cap report that was mentioned in the beginning, and was asking for you to give a few minutes on that, but we'll direct everyone to the small cap, the report that was talked about. Also surprised to see you guys do a crypto piece. And then how do I find out more information about your asset and wealth management services? And so what I'll do there is direct everyone to the prudentspeculator.com. In the member portal, you can find tabs there, one on wealth management, one on, I'm going to say it wrong and get in trouble with Chris, with our special reports. And so you can find the small cap report, you can find the crypto report there. And then on the wealth management tab, you can find out more about our asset and wealth management services, or you can reach out to me directly, jclark@kovitz.com, kovitz.com, and we can get you more information. And then what we'll wrap up with on this, and again, we thank everybody for attending, and any of the questions that we didn't get to, we will respond either to you directly or via the blog. And there was one other question I want to talk about. How can I get a copy of the presentation slide or rewatch this? We're going to post the replay on the webinar along with the slide deck in the special reports section. And that usually takes about 24 hours because we're going to go through compliance and have them look at it. And then we'll get it all posted up there so you can access it. So last question, John, as we wrap up. Newspaper headlines are very nerve-wracking. How do you keep the faith that stocks will continue to prove rewarding over the long term?
Well, I'm a guy who focuses on the numbers, on the facts. And just about every single thing that occurs has happened in some way, shape, or form before. So whether it's the presidential election, for example, if we go back to 2016, if Clinton won, the markets were going to tank. If Trump won, it was going to be even worse. Obviously, when Trump did win, the equity markets did tank for about an hour and then rally. So all of the stuff that you hear, in the press, on the financial television, what I encourage people to do is just take a step back, take a deep breath, and say, okay, this event occurred before, and we publish this stuff in our market commentaries, Russia, Ukraine. We've had drama with Russia in the past. We've had viruses in the past. The Middle East has been a hotbed in the past. It'll be a hotbed again. If we're going to sit here and say, I can't invest until everything is quote unquote okay in the world, I will say you'll never be able to invest. There's always going to be something to worry about. So I keep the faith by relying on the historical evidence that we've been through lots of scary things in the past, and yet we've managed to persevere through thick and thin. You know, I don't want to sound like I'm, got the flag over my shoulder, but America has been a fantastic country. It's been a great stock market throughout history, and I really don't see anything, despite our political divide that we have in this country. I don't see anything that's going to change that going forward. So that's what allows me to keep the faith. And of course, I've been doing it for 37 years, and I know we're going to need to wrap it up, but I was in Manhattan on 9/11 when the first plane went over my head. If we're sitting here today saying, in this country, this is a scarier time than it was on aftermath of 9/11. It took me, 4 days to get home, from New York City. That was pretty scary. And yet we managed to, get through that. For a moment anyways, we came together as a country. Unfortunately, we've gone the other way since, but we'll get through whatever, short-term difficulties arise. The key is having, faith in your businesses and the valuations of your businesses. That's what allows me to sleep at night. Yes, CVS has not performed well, but you have a company that's earning $7 a share and trading in the 50s and paying me a nice dividend. I like that. That doesn't cause me any consternation, and I'll continue to like that, for the long haul.
All right. Well, thank you, John. Last thing that we got a couple questions on was our 2024 equity outlook, because we always do a mid-year. And so there was a couple questions about when we might see that. And so you should see that in the first half of July. We'll do an update to our original 2024 equity market outlook. And so again, on behalf of John, myself, and our team here at the Prudent Speculator and Kovitz, we thank you for taking the time to join us today. Visit the website for a lot of reports, as well as additional information on our asset and wealth management services and strategies, or you can reach out to any of us directly. So thank you for your time, John, again.
I will say one more thing to those who have stuck around. I do appreciate the questions. A lot of the market commentary, the things that we put in there are direct response to queries we receive from our clients. And so, subscribers, please feel free to email info@theprudentspeculator.com with any questions, because we may actually address them, in the market commentary. So thank you very much for everybody taking part.
All right, everybody have a great rest of the day and week.